For many people, this week is the official start of the holiday shopping season. Well, on Money Life, this week and today's show is the official start of the outlook for the new year season.
Pulling back expectations for what the market can deliver, I think that's half the battle. When volatility hurts the most is when you didn't anticipate it and you didn't set up your financial plan to acknowledge for the possibility of volatility. So staying invested, but anticipating potentially weaker results, I think those two things are things that we have to kind of have walk hand in hand as we enter 2026.
That is Marta Norton, Chief Investment Strategist at Empower. And she is distinctly not seeing a bubble, but she does see conditions that should have investors curbing their enthusiasm in 2026. She's our big interview, but we start with Julius de Kempenaer, Senior Technical Analyst at Stock Charts. And he sees the market in a rotation towards defensive sectors, which suggests there could be some trouble ahead, especially over the next 6 to 8 weeks, when he's not that optimistic that the market is going to see Santa Claus this year. And in the market call, Dom Rizzo, Portfolio Manager for the T. Rowe Price Technology ETF and the T. Rowe Price Global Technology Fund, he's here talking about linchpin technologies and how they could make your portfolio sing for years to come.
Shazam!
Let's go! This is Money Life for November the 25th, and man, do I love this lineup. Yeah, this is a great show, as good as any we will do all year, and I know you might be thinking, oh, it's a holiday week. Does that mean that, they're taking it easy or taking things off? We don't take vacations when the market is open here on Money Life. We're here pretty much every day the market is open, and we will be this week. We'll take the Thanksgiving holiday, but we're otherwise here, and we've got great things coming. And today's show, seriously, does it get much better than this kind of a lineup? I mean, Julius de Kempenaer, a heavyweight in the technical world. Marta Norton, she oversees not quite $2 trillion is what Empower has in assets under advisement. And Dom Rizzo from T. Rowe Price Technology, T. Rowe Price Global Technology, the fund, so the traditional fund rather than the ETF, because the ETF's fairly new, the fund is well established. He's managing a couple $1 billion. So we've got big time names today talking serious stuff. We've got the market trying to figure out what it's going to do with retail sales and more. The conditions are super interesting. Although here on Money Life, we think they're always super interesting. But yes, right now it is a very compelling time. And I say that it's the opening of Outlook season because while I've been asking people to, give us, you're starting to put together your Outlook, give us a taste. Marta Norton and the crew at Empower, they just put out their Outlook. So this is the time when we start to get them. You get the first one or two right before Thanksgiving, et cetera. So for us, we are pretty much hammered down on outlooks. Like we just added Indrani Day from FTSE Russell, and they just put out their outlook. So she'll be here next week talking about that. And trust me, as we get into December, it is let's look ahead and try to put on the not so much crystal ball, but the just what are we looking at and how's it going to differ? And it's not that you're getting a lot of dire forecasts. Like Julius de Kempenaer saying Santa Claus may not be coming is not going bail out of the market. Far from it. But he is saying be realistic. And I have to say, I love Marta Norton's line on how when volatility hurts the most is when you didn't anticipate it, because it's crucial for riding things out. And if we think there's going to be stuff to ride out, you definitely want to be prepared. Hopefully we are helping you to do that preparation. Chuck at moneylifeshow.com is how you reach me if you've got questions, comments, suggestions for how we can do that for you better. But right now, what we've got is a great show, and I don't want to waste any more time, so let's get busy. I've told you what's coming. We're talking technicals to get this thing started when we come back in just a moment.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
Don't get technical with me.
But enough of my technical mumbo-jumbo. Allow me to demonstrate.
Oh, it's not technical mumbo-jumbo when you talk with the right expert, and we will demonstrate because this is Talking Technicals on Money Life. And returning to the show today, Julius de Kempenaer. Senior Technical Analyst at Stock Charts, creator of Relative Rotation Graphs. He'll explain a little bit about what that means and where things are rotating now. But if you want to learn more, stockcharts.com. Julius DeKempenaer, it's great to have you back on Money Life.
Thank you for having me again, Chuck. Always a pleasure.
We've got a market that has backed away from record highs, but it's still in the neighborhood. Is this the start of some sort of a rotation, some sort of step away, or is this just a little pause to refresh us for the next rally with maybe Santa Claus coming to town and the rest?
Oh, there is definitely rotation coming on. Well, as a matter of fact, rotation is already underway, that's for sure. I think the big question is whether this is the beginning of a bigger corrective move in the market or whether this is just going to be a little blip. And in my work, it's a little bit too early to definitely call that, but I do see rotations that are, let me put it like, caution to the stock market in general and technology in particular, because technology, as we all know, is 36% of the market at the moment. So, whatever happens to tech will impact the S&P 500.
How are you setting your expectations in terms of what could happen next if this is the actual rotation versus this is the blip?
Let me start from the top. What I do usually is start like a top-down approach, and I look at an asset class RRG, an asset class relative rotation graph. And that's where I plot stocks, government bonds, high yield, corporate bonds, cryptos, cash, all of that, commodities. And what you see there is that stocks, which I use SPY as the proxy, was on the right-hand side, which is the positive side of the graph, for a long time. It was driving the market. Basically, the stock market or stocks was the only place where you could get decent yield. And what you've seen over the last couple of weeks is that SPY has rotated out of that leading quadrant into weakening, and it's heading now towards the left-hand side of the graph. On the other hand, we have government bonds and other bond-related asset classes which have picked up momentum, picked up relative strength, and they're now getting closer together. So that is a first indication that stocks are weakening right now, and on the other hand, bond markets and especially commodities are picking up vis-a-vis the stock market. So that's a first indication that stocks may or are due for a little bit more of a corrective move. Now, I know we are most of the time looking at the stock market, and my next level of analysis is in sectors. And that's where you can see some interesting rotations going on, because the technology sector, as I said, has driven this market for a long time. It was for a long time the only sector inside the leading quadrant, carrying the weight of the entire stock market. XLK, the ETF that tracks technology, has rotated out of leading into weakening right now. But more importantly, what we've seen is that what we are seeing, what is undergoing, and that's, I think, the big rotation that people need to focus on, is that there is a rapid improvement of utilities and healthcare, and to a lesser degree, consumer staples. And as we know, those are traditionally seen as the defensive sectors. So healthcare, utility, staples, if the market is under pressure, investors go to these defensive sectors. And on an RRG, you can see that beautifully. You can see healthcare is now powering into the leading quadrant, utilities is following, and consumer staples is still inside improving further to the left, but it is on a positive trajectory. We call that a positive RRG heading. So what that tells me is that under the hood, people are shifting money to more defensive areas of the market. And that is usually a sign for a corrective move in the market as a whole. And as I said, it's a little bit too early to say whether this is causing a massive deterioration or whether this is just a shorter rotation. But I'm going to say that for the next 6 to 8 weeks, I think technology and stocks will be under pressure. And the best bets are now healthcare, utilities, and to a lesser degree, staples.
Does that mean that we're not going to have a Santa Claus rally? Because here we are at the end of November. So if you're talking about the next 6 to 8 weeks, that puts us into January. Do we miss a Santa Claus rally, and do we not see a January effect?
Hard call. I mean, there is definitely a positive seasonality effect towards the end of the year. What it could be is that it's just leveling out, so that we are not seeing a massive continuation, but that we're basically moving sideways. We see sector rotation, And if the sector rotation is strong enough, it may keep SPY at decent levels and a mild deterioration. I don't see it. Right now, defense is the play. I'm looking at a weekly RRG. I always tell people the kind of rule of thumb for like how long does a rotation last is like 3 months. So that would be even longer than that. Sometimes it goes quicker, sometimes it takes a little longer. But for now, defense is where the money is rotating to. And that doesn't really fit with a strong stock market. So maybe this year, the seasonality and the Santa Claus rally are not that present, will not show up that prominent, probably the best word to say it.
If we see a mild correction or sideways or what have you, what are support and resistance on the S&P for you?
That's a tough question. Obviously, the all-time high, if you look at SPY, that's 690, is definitely an important level. And I would be looking at 650 on the downside, because that's where we had significant lows being formed since September. So that's definitely a level to watch. If we drop below 650 convincingly, and convincingly for me is on a weekly chart below 650, close below 650, that would definitely open up more downside. On the upside, we already see on the daily chart a series of lower highs and lower lows. So what we call a downtrend is already present on the daily chart. From all angles, the upside for the S&P 500 for SPY is littered with resistance. Let me put it like that. The ease of movement seems to be to the downside. Is that a better way to say it?
Yeah, I like that.
I'm not super positive. 650 is definitely a line in the sand. If we take that out, then we will see more downside. The upside is problematic. 675 was a previous high a couple of days ago, and then we have 685, which was what was that? November, 12th of November, and then we've got the all-time high, 29th of October. All these highs are new resistance levels, and they're stacked lower highs, lower lows. I don't see too much upside for the time being.
Given what you see happening, how much are you moving away from technology and away from the SPY, because it is, of course, technology dominated, and looking to make money elsewhere? Or are you, let's be, keeping more powder dry for whatever we're going to get to after we get through this period?
Depends a little bit on whether you're an institutional player and you have to invest, or whether you're a retail investor and you've got all the freedom to do whatever you want. If you're a retail investor, then I would definitely make a little bit of cash. Don't be fully invested at the moment. Maybe move something to government bonds. I would definitely look into the commodity space. We've got DJP and GSG, which are great ETFs to cover the entire commodity market. They're looking really well right now. And if you're into, picking individual stocks, in the healthcare sector and utilities, there are some great stocks there. Before I was talking to you, I was looking at a few of those. And I think that in the healthcare sector, I really like Amgen. That just broke out to the upside. So with the current strength of the healthcare sector and the upside breakout on the chart, Amgen is really positioned very well for this period. I mean, even if the market goes down, you will always be able to find stocks that are doing, nicely on the upside. Maybe not as strong as if they would have been caught in a full-blown rally, but you will still find some of those stocks. In utilities, EIX is one of those stocks that I'm looking at. So because they have a nice pattern that goes against the general market, and with healthcare and utilities being the right sectors, I think stocks like that, that are either breaking out to the upside or they're coming out of a long bottom formation. They build a base and they're breaking out of that base. That's the kind of stuff that I like to look at.
Julius, it's the kind of stuff we love to hear about. Thank you for taking the time to join me. Happy holidays. Happy New Year. We will talk to you again in 2026, but thank you so much for your time today on Money Life.
Sounds great, Chuck. And happy holidays and a happy New Year. I'll see you on the other side.
That's Julius de Kempenaer. He's senior technical analyst at Stock Charts. You can go to stockcharts.com to get more information. He is the creator of relative rotation graphs. If you want to get more information on them, worth a look if you are into technicals. And if you're into living the money life, well, buckle up, because we just got started on a smoking hot show today. Up next, the big interview features Marta Norton. She's chief investment strategist at Empower. And then the market call has Dom Rizzo, portfolio manager for T. Rowe Price Technology. Oh yeah, we're living the money life and we're back at it in a flash.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
Welcome to the big interview on the November 25th edition of Money Life. And joining me now for the first time, Marta Norton. She's the chief investment strategist at Empower, which has, it's closing in, I guess, on $2 trillion in assets under advisement. I have to say, this is her debut on the show, and I have no idea. Like, I'm supposed to be going off and getting great guests. I think we do that most of the time, but we can't get to everyone. But I will say that 13 years into Money Life, I'm a little late in getting to say this. Marta Norton, welcome to Money Life.
Thank you. Happy to be here.
Let's start with just the base on where we are entering holiday season and holiday week. I mean, historically, everybody's hopeful that Santa is coming to town. We're going to get a Santa Claus rally and a January effect. But we've got a market that looks like it's struggling to bring it home at the end of this year. So where are you right now in terms of ease of movement? Is it going to be easier for us to coast to the finish line, or is it going to be easier for us to fall before we get to the finish line?
You know what's so interesting? I mean, we do have our seasonal views of how the market ought to behave. And November is actually one of those months that we expect really strong performance. And of course, this is one year that's an example of how we can't always trust the seasonality. It, comes down to the fundamentals. It comes down to where things are priced. And as we're standing here today, we're not someone who calls for an AI bubble, but we have raised a lot of concern around valuation levels. And that relates to technology. And I think we're seeing the effects of very, very high valuations and how those collide with questions, right? Fundamental questions on what's happening with the underlying securities. But we see that also broadly speaking. So across most sectors, healthcare being one of the few exceptions, you're looking at pretty high valuations. And so whether that means we'll continue to see volatility, through the end of the year, or we'll see it at the start of the year, it's our expectation that at least going forward, this is a risk that the market has to contend with.
You started that answer by saying we're not calling for a bubble.
Yeah.
We're not calling this a bubble.
Yeah.
So I need to know, why not? Because plenty of people are saying, wow, this feels kind of bubblicious. So why not?
Well, so something that's interesting on bubbles and that people talk about them a lot more than they actually appear in markets. And so as you think about what do we really mean by bubble, I tend to think that there's really three criteria that you really have to have. And any one of them on their own is kind of like a necessary but not sufficient condition. So one, you do have to have high valuations, right? Things do have to feel very excessively priced relative to the underlying value or the range of outcomes. We do have that. But what we don't have, in our view, is really excessive economic risk taking. So we do have levels where you are seeing circular financing in tech, you are seeing more debt issuance. But it was just back in really the first half of the year that people were looking at the hyperscalers and saying these companies are largely done. And in fact, they got pretty cheap in the wake of Liberation Day after they had the 1-2 punch of DeepSeek and then tariff concerns. So really a lot of the froth that we're seeing is something that hasn't been brewing for a very long time. And when you look at even the debt issuance that we're seeing with these hyperscalers, if you're looking at it from a debt to enterprise value basis, they are still well beneath what you would expect from someone with their heft and their capital structure. So I guess we're just not seeing that economic froth. We're seeing maybe the beginnings of it, but not excessive levels of it. And it's pretty interesting to watch how quickly sentiment has changed as well. So sentiment was pretty risk on for a period, but then you see this volatility and sentiment collapses immediately. So it's not as though there's this sense where people are saying, I need to get a piece of this. It's more a fear of a bubble. And I don't think that's typically what you see when you see a bubble. When you have fear in a bubble, it's more a fear of missing out than it is fear that something's going to collapse.
People who have been looking for better valuations for much of this year have found them internationally, but much of the international play, depending on who you talk to, has been driven more by the dollar than it has been by the valuations.
Yeah.
So if we're looking for places that look like they could produce more than the US moving forward, are we looking abroad, or has the dollar story played out so the valuations, they can only do so much?
Yeah, well, it does seem like some of the froth has come out of the dollar. If we're looking at kind of real effective exchange rates and using that as kind of a proxy for valuation, you could argue that we could see, further dollar declines, and you could put some narratives behind that, whether it relates to deglobalization. And when you take a look at just kind of currency cycles in general, they tend to be pretty long. So long periods of strength followed by long periods of weakness. I mean, multi-year, 7 year types of events. So I guess we're not necessarily convinced that the dollar, that all the froth and all the overvaluation has come out of the dollar. It just seems like when we're looking at the dollar versus other currencies, a lot of the concerns that people are focused in on the dollar, and a lot of it, of course, relates to debt levels in the US. Those are not unique problems to the US. In fact, if you're looking at advanced economies generally, it's a pretty indebted group. And you have some of those similar concerns in Europe, with France, or in Asia with Japan. So I guess what I would argue is that I think the dollar could still have some weakness in front of it, but it's not necessarily the same collapse that we saw in 2025. And then just on the point of international, I mean, it's kind of an interesting question, because as we stood here in 2024, the value was very evidently overseas. And that had been the case for quite some time. But it felt like, especially given all the enthusiasm that folks had around US stocks and President Trump's election, that it was especially pronounced last year. And then to your point, we see this reversal this year. Local assets doing well, but the dollar, in its weakness, pushing them even higher. Today, when we look at those same valuation metrics that we were looking at back then for the local assets overseas, they're just not as attractive. So it doesn't seem like the valuation argument as evident today as it was back then. But I think the thing I just keep coming back to is that people in the US, investors in the US, seem to be just under allocated overseas. And so even though the tactical argument isn't as strong, I think the structural argument to have a bit more diversification in a portfolio, especially if you are concerned about AI, US, China, those are AI hubs, but areas like Europe, you're not getting the same kind of AI exposure over there. And so you're getting other forces at play. And it's just a way to diversify, I think, a little bit more broadly.
Let's talk about that need for diversification as it comes together with your outlook for 2026. I should have mentioned at the beginning of this interview to my audience that you guys at Empower just put out your 2026 outlook. We have that linked up in our show notes, or if they find you on our guest page. But 2026, here you are talking about asset allocation.
Yeah.
In my experience, when somebody leads into an outlook and kind of says, check your allocation, that's another way of saying, buckle up.
I think that's true. I mean, and I know that you've covered this in your show, but we start the show talking about valuation and AI bubble, and we're not there, at least from our analytical perspective. But one thing that is undoubtedly true is the US is not the diversified market that maybe it once was. So it's super fascinating. You look at the MSCI global sectors, and 10 out of 11 of them, the US is more than 50% of each of those sectors. So you think this is a behemoth economy, and it is. But when you take a look at the US market and its, particular state, 36% S&P 500 in technology. You look at technology itself, and a handful of companies, maybe 3 companies, make up more than half the weight of that sector. This is one big bet in the US. It is one big bet on AI. That doesn't mean that there aren't other good opportunities to be had. They just don't dictate how necessarily the market cap indexes are going to behave the way AI does. And so, with that context in mind, we do think there's room for volatility, especially when you think about what AI is, which is a very long and extensive build out. We would expect, with that in mind, that there will be moments of doubt that periodically puncture markets, whether it relates to something like DeepSeek, or whether it relates to something like the circular financing, the debt issuance that is on people's minds today. There's just going to be moments of doubt as people wait for this to play out over a multi-year period. And that matters when so much of the market is dictated by how AI behaves.
If we know that because of the weightings, et cetera, that the indexes are flawed, and you're talking about asset allocation, what's better? Because you could sit there and go, okay, if I want more market exposure, et cetera, I go to equal weight. And if you go to equal weight, you go, man, that sucked. That performance was terrible relative to the cap weighted. So you can like the construction, but you're going to hate the results.
Yeah.
So given what we are seeing, is there something else that you are looking at, or is there another way that you can measure it so that as you're setting expectations for the investors who work with you in 2026, they understand that there can be a disconnect between your portfolio and the S&P 500, and maybe there should be?
Yeah. Well, so I mean, there's so many different ways to skin a cat on this one. And people are, I think, putting a lot of good thought into this idea of how do I mean, if I were to fall asleep and wake up in 10 years, I would not want to have sat out that AI trade, right? I would want exposure to it. But there's a few questions that come to mind. The companies that dominate today, are those the real AI winners? Or will it be something else? And how do we know who the AI winners are? How do we predict that ahead of time? I think that's something that everyone in the market is grappling with today. So you want to have exposure to the people who are winning today. You also want to have exposure to the people who potentially win AI long term. And you also don't want to have overexposure to this valuation thing. So, concerns that develop, particularly along the tech lines. I guess one thing that comes to our mind in this environment is the importance, and this is going to sound so banal, but is the importance of a very thoughtful rebalancing strategy where you really have thought about from any one individual's financial goal, what's the right exposures to these different assets within the portfolio. And as they move away from those targets, I need to bring them back. Because if we're anticipating kind of an uptrending market with spots of volatility, you want to ride that uptrend, but you also want to minimize the volatility. And so actively pulling weights back to target, I think is one way of doing that. I think another thing to consider, if you go from market cap to equal weight, you're essentially going from one side of the spectrum to another. But I think there's tweaks you can do that are more kind of in the center of that distribution. And part of it is just thinking through what are the areas that have been left behind. And healthcare is one of those areas that we have been pointing to that has been left behind for very good reason, right? You had the tariff concerns, you have policy concerns, you have drug pipeline concerns, but all of those issues have really weighed on the valuation. And it's popped recently, but that's been a pretty recent pop. And so some valuation opportunity is still left. So looking for those areas that have been a bit left behind and maybe giving them a little added exposure, I think is one way to at least introduce some positive valuation narrative into a portfolio that's dominated by these behemoths. So, I think there's kind of all of these different tactics that people can use to have potentially a better, more consistent experience in their portfolios.
I want to get back more directly to your outlook for 2026. Pointedly, your headline was actually about the labor market. It was not about the stock market, et cetera. It was about what's going to happen and how you expect 2026 to be an anemic year, your word, for the labor market. I want to know why you feel that's going to happen. But then I also want to know, what does an anemic year for the labor market say for what we're going to see from the Fed and interest rates?
It's a rock and a hard place, and maybe a third hard place right now for the Fed. When we think about the different conditions that we're navigating as we go into 2026, I mean, when we look at today's climate, we really think AI and the build out there is undergirding the economy and maybe softening the typical effects that we would see with a business cycle. But there's no question that the labor market is distinctly different than it was even a few years ago. I mean, the wild opportunities that were given to people, the wage gains that people made, particularly at the lower end of the spectrum, that was a really dramatic period in the US labor market. And what's been so remarkable is that shift away. In a large part, that relates to just what we've seen on the job growth front, which, we've really seen job growth grind to a halt. And though we found that out in kind of sudden fashion over the summer, it was actually something that was occurring over really the past year where we're seeing this job growth really slow down. But here's the thing that we're looking at when we look at how strong corporate earnings are and how we anticipate them to remain strong. we don't necessarily think that that anemic, you know, payroll situation is going to necessarily lead us to a very poor unemployment situation. We could envision a world in which the job growth isn't there, and that's difficult for folks who are unemployed, but those who have jobs are able to maintain them at least to a certain juncture. And so, how the Fed navigates that type of labor market, which is anemic but not collapsing, and at the same time handles questions around inflation and the stickiness that we've seen there, I think that makes for a difficult cutting environment. And so, that's something that I think is going to be another factor that we're going to be navigating in 2026.
Which brings us to what other points in your outlook. If the Fed's not cutting, somebody's paying higher rates. And that somebody, while we as consumers think it's us and we're getting the short end of the stick, it's more likely to be governments. I mean, Japan could be precarious if rates there stay high. Not that we're at that level yet in the US, but if they can't cut rates, separate from what it means for the market, what does it mean, for the country and for governance?
Yeah, I mean, this question of government debt is one of those questions that almost feels like a perennial problem, right? You always think it's going to be problematic in the next year, and then it never really manifests itself. Though, arguably, people were a little bit more focused on this question over the course of 2025 than they have been previously. I guess our view, if you expect, hey, listen, we know the labor market is more anemic than it was. We expect rates to come down, maybe not to the extent that the market anticipates, but maybe modestly lower rates over the course of 2026, but you still have this massive debt load that the US is carrying around. That ends up supporting potentially or keeping rates higher at the longer end of the curve. That means less relief for folks who are looking for affordability in the housing market. And it also means a steeper yield curve more broadly. And so when you think about a steeper yield curve, that's not negative in every sense. I mean, you're collecting higher income, right, as investors, but you're potentially getting less offset at the long end of the curve if equities sell off. You don't get potentially that same bounce because maybe the yield curve doesn't move as dramatically lower. And so those are the kind of dynamics that I think investors may be facing over the course of the next year.
Looking out, just as you put together your outlook, I'm curious. I mean, we're about to finish, even if we don't see Santa Claus jumping into the markets before the end of the year, we're about to finish our third straight solid year. And no, that does not mean that trouble is coming. And you've said we're not inflating a bubble, though we have some bubble-ish conditions.
Yeah.
But I'm curious how hard it is to be positive entering a fourth year, given everything that we've got and also the overhanging geopolitical risks and the rest.
I mean, there's two things that I think investors need to do, and they're kind of polar opposite types of recommendations. The first is, I think, at a most basic level, to stay invested. And this can be the type of advice that, you would give if you thought that there were really great times ahead for the market. But even if you have concerns for the market, one thing that we found is that it's really hard to predict with perfect clarity when volatility hits. And if you're pulling in or pulling out of the market based on political views or an economic perspective or fears around government debt or AI, you often end up missing a lot of run as you've kind of sat out the market. And yet at the same time, I think to your point, we've had tremendous years, year after year after year. We've really reaped a lot of gains, particularly from AI and technology in general. And pulling back expectations for what the market can deliver, I think that's half the battle. When volatility hurts the most is when you didn't anticipate it and you didn't set up your financial plan to acknowledge for the possibility of volatility. So staying invested, but anticipating potentially weaker results, I think those two things are things that we have to kind of have walk hand in hand as we enter 2026.
Last question in somewhat limited time. If you and I talk again a year from now, because it's not going to be the length of time that I've been doing this show and we haven't had you on. So if we come back next year and you have to say, okay, I made my forecast, I talked to you about it, but I was wrong.
Yeah.
What's the thing that you have the biggest worry that would blow things up and make you wrong?
Yeah. Well, two worries, I think. One is whether, I'm of the view that AI is undergirding the economy But am I missing something? Is there a greater weakness in the economy than I anticipate? And is that, a cost to the economy from a recession standpoint or just an economic or market standpoint? So that's one thing that's top of mind. That I, continuously read those who are more bearish on the economy than I am, just to make sure I'm understanding their argument, and incorporating that perspective into kind of the range of outcomes that I anticipate. I think the other thing relates back to that national debt issue. We know that this is a problem, we just don't know when it's a problem. And so over analyzing that or putting too much weight on that, I think that's always a risk that we face when we're looking at these perennial secular concerns.
Well, Marta, this has been great. I do have a few more questions. I just don't have any more time. So we're going to have to cut this one short, but thank you so much for joining us. We will have conversations moving forward. Thanks again for taking the time on Money Life.
My pleasure. Thank you for having me.
That's Marta Norton. She's Chief Investment Strategist at Empower. You can learn more at empower.com. And if you find where we have mentioned her in our show notes, or you find her on our guest page, there will be a direct link to the 2026 Outlook that we discussed. Up next on Money Life, it's market call time. Dom Rizzo, portfolio manager for T. Rowe Price Technology. He'll be here talking stocks when Money Life returns right after this message.
Asset managers, you know how hard it is to stand out in this crowded space. Vetify is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, Vetify can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at vetify.com.
Dom Rizzo, portfolio manager for T. Rowe Price's Technology ETF, is here. We're talking tech stocks. It's time for the market call. Welcome to the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market or in their sector, and how they put it all together. Making his debut on the show today, Dom Rizzo, portfolio manager for TTEQ, that's the T. Rowe Price Technology ETF, also manager of T. Rowe Price Global Technology. That is ticker symbol PRGTX. So if you want to learn more about the firm and the funds and Dom, go to troweprice.com. Dom Rizzo, welcome to Money Life.
Hey, Chuck, how are you? Thanks for having me.
We always start with methodology, and you run two funds, and they are not identical methodologies. So first, give us a little setup about how the funds are different and what they do. And then, because you are looking functionally and putting the same methodology to work in both funds, maybe with a slightly different purview.
Yeah, great question. So if we just take a step back, how we make decisions across either strategy is actually the same. Linchpin technologies, innovating in secular growth markets with improving fundamentals at reasonable valuations. And we'll get into each of those four different things. But that's how I invest, right? That's how I make buy and sell decisions. And kind of regardless of what the strategy is, that's how I'll always make my buy and sell decisions. That being said, I think that what was great about when I was asked to take over the Global Technology Fund, which I took over on December 1st, 2022, very lucky timing in life. I took it over the day after ChatGPT was launched. Or when I was asked to create the technology ETF, is that different investors have different needs and you can invest in technologies in different ways. So if you think about the Global Technology Fund itself, it's much more of a traditional IT services focused fund. So the best passive competitors there, the ones that people would know, are names like XLK, VGT, IXN, that's, State Street XLK, Vanguard Tech. And it has a bit more concentration in it relative to other areas, right? In traditional IT focused strategies, you could see 40% plus concentrated in the big three names, Apple, Microsoft, and NVIDIA, and our ability to trade between those three can add a lot of value for our clients. And of course, we take a broader purview as well. If you take a look at TTEQ, the best competitor for us is clearly the Qs, right? QQQ, been around forever, super liquid. A bit more of a broader approach to the market. Doesn't really matter if it's IT services, communications discretionary, or consumer discretionary or communications. We can kind of apply our framework across the broader spectrum and a result have a little bit broader and then a little bit less single position concentration. So no name in TTEQ over 11%. And so that's how I kind of think about the different areas. But like you said, how we make decisions always comes down to our investment framework, right? And those are those four things that I'm looking for: linchpin technologies, innovating in secular growth markets with improving fundamentals at reasonable valuations. And I'm very happy to kind of go into each of those.
Yeah, please do. But before you get there, I want to point out for my audience that we are dealing with two very different funds from the standpoint of asset size, et cetera, in that PRGTX has 3 billion plus in it and has been around for some time, though you took it over, as you pointed out, at the end of 2022. TTEQ has been around for just over a year. So I want to go into all those things, starting with linchpin technologies. But first, out of curiosity, what we hear as individual investors is, ooh, a small fund, it's more nimble. It can do other things. Is that a thing? Like, you're running two different funds. How much does that play in when you're looking at the same things at times for both portfolios potentially?
Yeah, of course, how we think about deploying capital, obviously size is a factor. But I would just say, TTEQ is just far earlier in its life cycle, right? If I compare it to global tech, the global technology strategy at T. Rowe actually has the same birth year as me, 1993. So it's been around the same amount of time. And so it's had a lot longer to be around now. The strategy is across not just the US vehicles, but, vehicles all around the world for global tech as well. On TTEQ, I think what we tried to address when we came up with the concept is we looked around and we said, hey, there's actually some serious problems with the Qs. And despite its great history, its liquidity, its size, you look at QQQ and there's a few things I think need to be addressed. So number one, 20% of QQQ are things like Costco, Marriott, Pepsi, Lindy, these names that are not inherently technology names, right? Yeah, everyone uses QQQ as a technology vehicle. And so we said, okay, wait a second, let's just start with only technology, true technology companies. Now, whether or not it's classified as consumer discretionary like Amazon is, doesn't really matter, but clearly Amazon's a technology company. From there, we also said, what else can we look at? Number one, concentration, 100 names versus, 50 to 60 names. And then number two, we can actually apply our global framework. I think T. Rowe has a differentiated process in global. I have analysts all over the world: Hong Kong, Singapore, Japan, Australia, London, New York, Baltimore, DC, California. I have people everywhere. And so we can apply our framework really to a global opportunity set. And I think that can give a differentiated view. And then finally, very excitingly, we could do privates in our ATF. And so I think that can be a real differentiator as well.
And when you're doing private stuff, I mean, I know that you have open AI in TTEQ. How does that play for something that has to market every day and all the rest? How does that work out from that perspective? And how much influence will private stuff have? How much can it even be in the portfolio?
Yeah, well, for all 40 Act vehicles, you actually can't go over 15%. So in the global technology strategy, we've been doing privates for a long time as well. I think crossover investing is a really important part of some of the differentiation that we can offer our clients versus passive. So number one, differentiation, I think, is stock selection. That's the framework. Number two is being able to apply this global framework with all of our analysts around the world. And then number three, I think crossovers is a really powerful indicator. T. Rowe Price has been doing crossovers back to the 90s, and we've done well over $20 billion of crossovers at this point. When I think about OpenAI itself and how it fits my framework, I really think they have the potential to be the aggregator of aggregators. And what do I mean by that? Right, in zero marginal cost businesses like the internet or applications, if you control demand, all supply commodifies for you. And so a great example of that is Uber, right? Uber was so powerful because they controlled the demand of the ride hailers and they were able to commodify the ride providers. In the future, if OpenAI through ChatGPT truly builds this universal personal assistant that knows you incredibly intimately, I think that they can aggregate the aggregators. And if you're going on a trip, say, you say, hey, OpenAI, hey, ChatGPT, just book the trip completely for me. And whether it's Uber or Lyft or a private car service, it actually doesn't matter at that point. So again, extreme linchpin technology, potential to be an aggregator of aggregators, using our framework, just applying it to the private market.
Okay, so we've got also in that answer a pretty good understanding of linchpin technologies and what you say you're looking for. The next of your four standards was innovating. Can you have linchpin technologies that are not innovating in secular markets?
Well, innovating in secular growth markets really comes to taking share in fast growing end markets, right? So you can have a linchpin technology that's mission critical to the success of their customers, and they're selling to losers, right? And I don't like those stories. So I tell our team all the time, we don't buy companies that sell lifeboats to sinking ships, right? We only buy companies that are serving healthy, growing end markets. And so I'll give you a great example. What's the healthiest end market in the world right now? Probably AI chips, right? We're going from a $200 billion AI chip world, $250 billion AI chip world in 2025 to $1 trillion by 2030, according to AMD. So that's about as healthy of an end market that you can serve. And so when I look at the digital semiconductor companies, whether it's Nvidia, whether it's Broadcom, whether it's AMD, they're all serving this super healthy and growing end market. And so they're innovating in this secular growth market. And so that's a super exciting thing for me.
There are two more pillars that we need to cover here quickly. One is valuation, which is probably the easiest, although we still need to know what your metrics are.
I'm going to, Chuck, I'm going to go straight with improving fundamentals and then come to valuation, if that's okay.
Okay.
So improving fundamentals really focuses on three things. We look for revenue that's accelerating organically, operating margins that are expanding, or free cash flow conversion that's improving. And basically what I found is if you grow faster this year than you did last year, it ends up being a pretty good stock. If you have 90% incremental operating margins or 50% incremental operating margins, like much of tech is, that accelerating growth comes at a very, very high incremental operating profit number. And then going forward, a big question for a lot of the universe is what's going to happen to free cash flow conversion, right? As we do this immense AI build out, what happens to free cash flow for many of these companies? But most of these companies still have revenue that's accelerating and EBIT margins are expanding. And then that comes into valuation. The reason why I wanted to do valuation second is because valuation is a function of a million different things, right? It's like beauty, it's in the eye of the beholder. Extreme valuation is an issue in tech often, and I can't tell you what it is, but I know it when I see it, like the famous Supreme Court case. And I'm very happy to hold a stock with a little bit higher valuation that has improving fundamentals versus one that has a higher valuation that has fundamentals that are deteriorating. And so those two pillars kind of go hand in hand.
So quickly, what that also means is that one thing falling away a little bit is not enough to make you sell.
Inherently, yeah. Because at any given point, you may have a company that is a linchpin technology innovating in a secular growth market with improving fundamentals, maybe a little expensive. We can trim the position back up later. Maybe they have slightly decelerating growth, but the valuation's super attractive. You have to put all these different pieces together and come up with the overall strategy. And then we narrow the universe of thousands of companies down to, 50, 60 names.
A poster child for the methodology that is not a private stock, since my audience is going to want to hear about it, something where they can maybe get a little more information than they can on OpenAI.
Yeah, AMD is probably the name that fits the framework best today. So why is that? Number one, I think AMD is an absolute linchpin company. So whether it's in their core CPU business or in their GPU business, or frankly, their FPGAs, and I can get into each of those three different types of chips, but we could just use the acronyms from now and you could trust me. They are absolutely mission critical to the success of their customers. Innovating in secular growth markets, they're taking share in the fastest growing end market that I've ever seen in my career, and I think that many of us will ever see in our career, which is AI chips. And if we take a step back, why are AI chips accelerating the way they are? It's really a function of this thing called the scaling loss. If you throw 10x more compute at the problem, the artificial intelligence gets 2x smarter. And many people don't want that to be the case. It almost sounds too simple. Wait, you're just telling me we throw more chips and the model gets smarter? Well, yeah, that's actually the answer. If you throw more chips at the problem, the model does get smarter. And I think ChatGPT was so powerful because when it came out, it may have had an IQ of, 100 or 105. You could talk to it like you were talking to a person. It was really the first thing that you used that probably passed the Turing test. And then the latest models were probably at, 115 to 120 IQ, and they kind of keep getting better. Maybe we're going to 125. And as you unlock those new IQ levels, you can start giving it tasks and memory and the ability to build all those things. And that's why when I put OpenAI through my framework, say, oh, they have the potential to be the aggregator of aggregators, they're going to go partner with AMD to try to commoditize their complements. Who's their ultimate complement? NVIDIA, right? They know that NVIDIA, the real economic battle over time for who has monopoly profits in AI, I think personally, is OpenAI versus NVIDIA, or is it an integrated model like Google and TPU? And so that makes AMD an absolute mission critical supplier to the entire ecosystem because they keep NVIDIA's monopoly profits in check, right? Now, I think NVIDIA is going to be a great stock from here too. And I think this market is so big that all these companies can win. But that's just a little bit of a broader framework for how I think about it. If I move to the improving fundamentals bit, from here, because we have CPU growth accelerating their core business, this is the business that sells chips to PCs and data centers, because they have the GPU adoption, revenue growth should accelerate. That should come with EBIT margins that are expanding. And then on valuation, they basically laid out at their analyst day the other day that they have a path to over $20 of earnings. Now, as we sit here, the stock is in the low 200s. I think that valuation is relatively reasonable in that context of growth. So that name fits the framework very well today. And you can see we've owned it for a while.
Well, now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
1980-something technology? Now you're talking!
Yeah, no, we're not talking about 1980-something technology. You have to have the linchpin technologies. That's what Dom Rizzo has been talking about. He is portfolio manager for the T. Rowe Price Technology ETF TTEQ. Also, T. Rowe Price Global Technology, PRGTX. Learn more at troweprice.com, TROWE price.com. You know how quick and dirty works? We are late getting here, so we're going to jump straight in. We're going to start with two requests for Richard in Chula Vista, California. He shares the first one with Steve in Royal Oak, Michigan. That one is for Robinhood Markets, ticker symbol HOOD.
Yeah, incredible company, incredible app. I think they're building the financial services super app for the younger generation. I'm a little worried about the near-term crypto trading revenue, but I think they'll power through that over the time. They're a little expensive, but absolute linchpin technology.
So there's your linchpin technology, but the worries make it.
I'm just taking my time before making the move.
That's hold it if you got it, but you're looking for maybe a better opportunity before you are buying HOOD, Robinhood Markets. Richard's other request by himself, Applied Materials, AMAT.
Yeah, you can go look. We have a ton of semi-capital equipment exposure today. I've mostly done that through the international names, but I really like semi-cap positioning because we need to go build out all these fabs in order to build out all those AI chips. And I think AMAT's very well positioned. I think H1's a little softer than H2, but the stock's trading at a relative low to the peers. And so overall, I wish I had more semi-cap.
When you buy here, it's going up.
Yeah, that's the expectation on a stock that you just heard Dom say he might be wanting to buy more of. Applied Materials, AMAT. David in Missoula, Montana wants to know about JD.com. That ADR trades under ticker symbol JD.
Look, JD is a really interesting company, but from here, the growth is going to decelerate due to last year's high base in appliance and electronics. They got really benefited from the government subsidies last year. They're also in a little bit of an awkward position when it comes to food delivery. They're subscale versus Alibaba. They only have 11 million daily orders versus Alibaba at 70 million. So I think it's a tougher setup there.
It's topped out. I say we sell now.
Well, he didn't say fully that it's topped out. What he said is tougher sledding going forward, not as attractive on JD.com, ticker JD. And Sam in Waterfleet, New York gets our last two requests today. The first of those is for Micron Technologies, ticker MU.
So I don't own Micron specifically, but I'm very, very bullish on the memory space. I think what's happening in DRAM is that we're going to see the core DRAM business accelerate from here as we see a recovery in CPUs and smartphones and PCs and server spend. And then GPU demand for what's called high bandwidth memory is extraordinarily high. And so I think the entire memory ecosystem is going to do really well. Micron, Hynix, Samsung.
So good industry, not the stock he is playing there. That's hold it if you've got it, but you're looking for the other players in the industry on MU, Micron Technology. And our final request, again, for Sam in Waterfleet, New York, Salesforce, ticker CRM.
Yeah, I think the entire application software business is, quite difficult to analyze right now. I think that gross margins actually need to go down across the industry as these companies invest in GPUs and models. And so it's very tough to get comfortable with that one, especially because we're seeing increasing competition from the model providers themselves, but also from new age startups. So really tough setup there.
This looks extraordinarily bad.
Yep, and a tough setup is something that maybe you don't want to be looking for when you can go after other things that are linchpin technologies and have the improving fundamentals at reasonable valuations. It's why Dom Rizzo's not there. When maybe you shouldn't be there either. But Dom, this has been great. We think it's fabulous that you came and talked to us. We hope you'll do it again with us down the line sometime.
Thanks, Chuck.
Dom Rizzo is portfolio manager for TTEQ. That's the T. Rowe Price Technology ETF. He's also a portfolio manager for PRGTX. That's T. Rowe Price Global Technology Fund. Learn more about the firm and the funds and Dom by going to troweprice.com. And we will come back and put a bow on this show. We'll let you know where Dom agreed or disagreed with some recent guests. And we'll wrap things up right after this message. We are back to wrap things up. I hope you enjoyed this show. I think that was a great lineup with 3 great interviews. I let them run, so I'll keep this short. We're going to start with crossover, which we had with Dom Rizzo from T. Rowe Price Technology. He mentioned Uber as an example of linchpin technology. It was a buy from Vijay Marolia, who has the 5 lens approach from Regal Point Capital back on October the 8th. Vijay will be our new guest regular. He will be doing something we call the week that is, and that starts next Monday, or that's the plan at least. So somebody who we're interested when something agrees with him. Then you got into Robinhood. It was a hold to buy, and I need to make it very clear that although I said you weren't buying more, Dom Rizzo has that stock in his portfolio.
Am I making myself clear?
I'm not sure I did make myself clear before, but I am now. He had it in his portfolio. He's holding it, waiting to buy more. So it was a hold to buy. You had Hal Lambert from Point Bridge Capital, the MAGA fund, MAGA ETF. He was buying it on October the 21st. AMAT, Applied Materials, it was a buy today. Dryden Pence from Pence Wealth Management was overweighted on July the 2nd. Micron Technology, it was no better than a hold today. He likes the space, but he prefers other DRAM businesses. But Scott Bennett from Invest with Rules, he had it as his poster child on September the 17th. And Eric Marshall from the Hodges Funds was buying it on July the 18th. Then you had Salesforce. It was an avoid or a sell today. Dave Sekera from Morningstar was buying it on August the 8th. So there's your crossover. Tomorrow we're going to have more great talk. It's going to include Todd Rosenbluth a day early because of the Thanksgiving holiday. But we've also got Tom Stringfellow, Chief Investment Strategist at Argent Trust, and more. So lock us in and plan to be here. Meanwhile, if you're looking for something to celebrate, you don't have to do much today because it's Blasé Day. So you don't really want to celebrate it. You want to be blasé. But you can't be blasé about playing with your father. And it's National Play Day with Dad. So yeah, if your dad is around or if you are a father, take advantage of that one because those opportunities, man, I'd go out and have a catch with my daughter Whitney every time we get a chance. We go off and handle lacrosse sticks. I would play with, I want to play with my kids and my grandson Declan when I get a chance to do that. It's also Shopping Reminder Day. I can be blasé about that. I cannot be blasé about the fact that it is National Eat with a Friend Day because it's always great to have somebody that you can go share a meal with. And then last, top your meal off with Parfait because it's National Parfait Day. My guests today were Julius DeKempenayer, Senior Technical Analyst at StockCharts.com. Marta Norton, Chief Investment Strategist at Empower.com. Dom Rizzo, Portfolio Manager for T. Rowe Price Technology and T. Rowe Price Global Technology, TTEQ, and PRGTX. That is TRowePrice.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Ken Hubbard, who said, "A lot of Thanksgiving days have been ruined by not carving the turkey in the kitchen." Yeah, That's called preparation and perspective. And that's what you want to have for the market too. Preparation and perspective. So if you're prepared, it should make it easier for you to remember that, hey, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll be back with you for more Money Life tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
That's one small step for man, one giant leap for mankind.